Hello everybody, the Canadian Investor here. Today we'll be looking at index funds and what is an index funds versus individual stock picking, and lastly, which one is the best for you. Well, I will help you decide if you should invest in index funds or pick your own stocks to invest in. Let's get right into the video. Number one, what is an index fund? So index funds track many different companies in many different industries. Depending on which index you look at, there can be many different types and many different sizes of index funds. So here are a few examples. So we have the Dow Jones Industrial Average. This is made up of 30 large market cap stocks. So very, very big companies such as Boeing and IBM, these massive companies, and less diversified than certain other index funds. But as we go on, you'll see there are some larger index funds as compared to others. And the larger they are usually more diversified and usually carry less risk. Not all the time, but let's go with that. So S&P 500 made up of 500 large cap stocks. These are also larger-ish companies, but as obviously there's 500 of them, so they're not going to be as large as the ones in the Dow, but it's a lot more diversified than the Dow. And yeah, so then there's the NASDAQ made up of 3,000 stocks. This one's a lot larger, and it's not part of the New York Stock Exchange. It's part of the NASDAQ. It's a different exchange. And then there's the Russell 2000 made up of 2,000 small cap stocks. These ones are much smaller companies as compared to Boeing and IBM and all these massive corporations. So index funds, how do you actually invest in index funds? So when you want to invest in an index fund, you can purchase an ETF that tracks the index fund. So basically an index fund is just an average, a calculated average, and you can't really invest in them directly. However, you can invest in ETFs that track them, that have the exact same stocks in them as compared to the actual index themselves. These ETFs are a diverse combination of stocks, and it's a lot more diversified. You're a lot more diversified if you're investing in index funds as compared to individual stocks usually. Now let's go to number two, index funds versus individual stocks. So now we'll be comparing the two on certain bases. So the first one, index funds are safer investments usually as compared to individual stocks. However, individual stocks you can get better gains. Also, index funds are more diversified, whereas individual stocks are more concentrated to your circle of competence. Now, Warren Buffett speaks about this circle of competence a lot, and he tells you not to invest in companies that are outside of this circle of competence. The circle of competence includes things that you really understand, and he tells you not to invest in companies you don't understand. And this is very logical. You can't invest in a company that you don't understand. If you don't know how the business works, if you don't know how the business makes money after researching it, not obviously just looking at the company and saying I don't understand it, that's obviously not good enough. But after researching the company, seeing how they make their money, if you don't understand the company, even after all this hard work you put in, then it's not a good investment for you. However, index funds are diversified and they include some companies you don't understand inevitably. Lastly, we have index funds require no work and is considered passive investing, whereas individual stocks require effort and being an active investor. So index funds usually can just throw money at them and track the overall general market and how the markets are doing. However, individual stocks, you have to pick your own stocks. You have to pick which companies you like, why you like them. You have to research their revenues, their profits. You have to look at their financial statements, listen to conference calls. You have to do all these things to be able to understand the company and to see if it's a better investment than the overall general market. So depending on what you're trying to accomplish in the stock market, you can go either way. Now, we're going to be looking at which one is better for you, which one is the best option for you to go with to be able to make the most money in the stock market or to be the most successful you can be in the stock market. So who are index funds for? So index funds are basically for lower risk, better returns than saving accounts, and no research needed, very little effort, and you want to maintain wealth. So basically index funds are a lot more safe than individual stocks. Basically the majority of people that look at index funds are to maintain wealth rather than to create wealth. You made your wealth, you're 40, 50, 60, 70 years old, and you want to maintain your wealth rather than create more wealth. So basically, this is more for people that are a little older, whereas individual stocks can bring you a higher possible return, but time and research is required. This is more for creating wealth, and you can make yourself a personalized portfolio. You can build your own portfolio according to your circle of competence, and then you can, if you have a higher risk tolerance, or you're able to detach emotions from your actions and all these things. So let me explain more about these two. So index funds, you have a lower risk. You're more diversified. You're more involved in the many companies in the overall market. So the S&P 500, for example, the 500 large cap stocks it tracks, these 500 companies make 80 or 90% of the economy basically in the US. So it makes up a large portion. So you're very diversified in the types of industries you're in and the types of companies you're in. Whereas with individual stocks, you can pick your own stocks. If you're not interested or you don't understand energy stocks, for example, you don't understand insurance companies, you don't understand a certain type of company, you're not forced to invest in it. Whereas in an index fund, it's inevitably included in the actual index fund, in the ETF you are investing in. Now, this can be good or bad. It can be good because you're more diversified. So if one industry is doing worse and the other industry is doing better, then they balance each other out and you don't have much movement. Whereas in individual stocks, if you are only concentrated in certain industries, let's say 4 or 5 different industries, and a few of those industries aren't doing so well at one moment, your wealth is going to decrease substantially. However, you do have the increased ability to have possible higher returns on your investment. So index funds usually don't move that much. They usually go up about 7 to 10% per year. An average of 8% usually is the given number, but in individual stocks, it's very much possible to make a lot more than this, and it's also very much possible to lose a lot more than this. There's obviously going to be years that even index funds go down, such as market crashes, recessions, depressions, all this sort of stuff. But individual stocks, is very easy for one company to do very badly, very poorly, and go bankrupt. And you know, depending on which company you're investing in, obviously, if you're investing in a Disney or Facebook or huge corporations such as those, it's not as easy for them to go bankrupt. But if you're investing in smaller cap stocks and with those valuations under $1 billion, you know, they're quite smaller, so it's not as difficult for them to go bankrupt and to completely destroy your portfolio. If you have one bad stock, it's obviously going to affect you a lot more than having an index fund which tracks 3,000 stocks, and one stock is a bad apple. Well, the other ones won't be as affected as negatively as if you have your own individual stocks. Now, time and research are required. As compared to index funds, you don't need any research. You just throw in your money at the ETF. Individual stocks, when you're looking to invest in individual stocks, you're going to have to do a lot of research. There is a lot of time put in. It's not just throwing money at any company you think is a good company. Now, obviously, to get the idea of which companies you want to invest in, you're going to have to look at which companies you believe in the long term. However, it's not all about this, and you do have to look at the 10Qs, the 10Ks, the annual reports, the quarterly reports. You have to listen to the conference calls. You have to do your own research. You have to do all these things, and this is a quarterly thing. So every 3 months, you're looking at them. You're looking at the quarterly reports. You're looking at the annual reports every year. You're listening to the conference calls every quarter, and you're making a decision every single time if you should keep holding the stock, if you want to sell, if you want to buy more. So it's a lot. It's very time consuming, especially if you have many stocks. Which usually you should have in a portfolio. However, in an index fund, you don't really have to put in all this work. So if you don't really have that much time to do, or you just want to get the overall, just a little bit better gain than a savings account, which returns a few percentage points here and there, if you want to just stay with the overall market, the general market, then that's the way to go with the index funds. But individual stocks, a lot more effort and a lot more time required. Index funds, more for creating wealth. If you're teenager, 20s, 30s, you're looking to create wealth rather than maintain, in individual stocks is for you, along with time, if you have time to put into it. Obviously, if you don't have time, then index funds, just put your money in index funds, and that's the best way for you to go. Next, we have higher risk tolerance and the ability to detach emotions from one's actions. Alright, so this is a massive point. This is the last point I'll bring up, but being able to tolerate risk and to detach your emotions from the market. Okay, so these are two different things. So higher risk tolerance. What does this mean? So higher risk tolerance is you are looking at a stock and it goes down 20% in one day. How do you react? Does it affect your sleep? Are you not able to sleep at night because you're worried that your stock is going to go down even more? Or are you thinking about selling it because the stock goes down? This is one of the worst things one can do. If the stock is going down, nothing changed with the company, then why would you sell a stock? For example, if you're buying something you use on a daily basis, and you buy toilet paper, let's say, and you buy a roll one day for $1, and then the next day you go back and it's at 75 cents. Do you go back and return the toilet paper? No, you buy more and you store them for when you need them. However, with stocks, people don't seem to think this way. They seem to think that if it's going down, one should sell, and if it's going higher, one should buy. Whereas it should be the opposite. When a stock is going down and it's still interesting to you, well, then you should be buying rather than selling. And this is the way to create wealth in individual stocks. Whereas an index fund, you don't really have to pay attention to all this. You just put your money in there and it's going to work for you. It's going to go up the 8% per year, 10% per year on average. There's going to be bad years and good years, obviously, with everything else. But overall, you're going to be getting the general market's returns. And lastly, you have personalized portfolio. You can choose your own stocks according to your circle of competence, seeing what stocks you understand, which companies you believe in the long term, rather than just investing in an index fund that includes some stocks that obviously are going to be garbage. I mean, inevitably, there are going to be stocks that you don't like, but you can't do anything about it because it's just there. It's already a pre-created portfolio, whereas with individual stocks, you create your own portfolio. And you have to be able to detach emotions from one's actions. So, for example, someone who's investing in the stock market and sees their portfolio go down 3-4% in one day, very possible. And you can't let this affect your emotion. You can't let this affect you. And you can't be not able to sleep at night because your portfolio is going down, or if you're losing money on one day and thinking of selling all your stocks and just getting out of the market. Well, obviously the individual stock picking is not for you. So you're gonna have to look at these things. You're gonna have to decide for yourself which one is best for you. Obviously, I went through the tough part, but you're gonna have to obviously choose which one you think is best for you. Well, guys, that's the end of the video today. Hope you guys enjoyed the video. Don't forget to leave a like and subscribe if you did, and I'll see you in the next one. Have a great day.